Okay, Ben, a new viewer question. Let's see. Can you explain the difference between direct recognition and non-direct? Which is better, and what does Penn Mutual use? Good question. So, direct recognition and non-direct recognition has to do with whether an insurance company recognizes the loans that you have against your policy. With a non-direct recognition company, they ignore that you have a loan, and you will continue to get a dividend rate payout on whatever your cash value is, okay, and whatever your premiums are that you've paid into it. They're basically, when they divvy out the dividends to all of their policyholders, they're going to ignore any loans. You're just going to pay whatever the loan rate is, fixed rate or variable rate or whatever it is that they offer. Direct recognition companies recognize that you have a loan out, and they're going to do something with that recognition. Now, what they do with that depends on the company. With Penn Mutual is a direct recognition company, and they have a fixed interest rate at 6%. And when you take out a loan for 6%, you're no longer going to get that 6.1% dividend. That's their current dividend rate. What they're going to do is they're going to give you 0.5% less. They're going to credit you 0.5% less than the 6% loan rate. Okay, I talked about it a little bit earlier in this live stream. I don't like it. That's like one of the things that I don't like the most about Penn Mutual's policies. Doesn't make them a bad policy. It doesn't make it a bad company. It's just one part of it that I'm not too thrilled about. I plan on trying to get around that because I want to get one of their policies. I don't have one yet, but I want to get one. And I plan to get around that by using outside collateral, by using that cash value in that policy as collateral for a loan, for a line of credit outside of the policy. So I'm going to go to a bank or credit union, and I'm going to find somebody who will give me a line of credit based on my cash value in that Penn policy. So I don't have to worry about that. Now, Guardian, another direct recognition company, they give you a 6% fixed loan rate, but they credit you 6%. So you get it's essentially what's called a wash loan. Most of your IUL carriers offer you a mix of the two. You can either choose loans that are wash rate loans or fairly close to wash rate loans, mimicking direct recognition companies, or they will offer you an index loan, which is not recognized, and that mimics the non-direct recognition companies. So that IULs kind of give you the best of both worlds, and you kind of get to decide how you want to handle those policies. Mass Mutual is a non-direct recognition company or a direct recognition company. They'll actually offer you both options. With their non-direct recognition, you get a 5% variable rate, and you get their dividends. So you'll get the dividends, which currently is 6.2%. So that's a nice spread that you get right there. With their fixed rate option, they give you 6% for the fixed rate, 6% is the fixed rate for your loan, but they'll credit you 0.5% higher than whatever the dividend is. That's a pretty good option. Now, currently, that means the loan rate is 6%, and they're going to credit you 6.7%. That's pretty solid. It's not as much of a difference as their non-direct recognition option, which currently 5% and 6.2%. So you got a 1.2% spread. Now recognize this is the cost before insurance. So you don't actually see that 1.2% spread. You won't actually see that 0.7% spread. With Guardian, you won't actually see an exact wash rate. With any of the IUL companies, you won't see an exact wash rate because there's insurance costs that are going to come out of those policies as well. Okay, but it's the starting point. It's the starting point, and those are the gross numbers that they work with. So when it comes to which one is better, I don't think one is better than the other. I think that it's situational. I prefer to have, and I do have, policies that are both, so that I can decide down the road where's the best place for my money. Now with Mass Mutual, you have to decide when you start the policy which one it's going to be. Are you going to pick the fixed, or are you going to pick the variable? Are you going to pick the direct recognition or the non-direct? when I got my Mass Mutual policy, they didn't offer that 6% fixed with the 0.5% higher of the dividend rate. They didn't offer that. So I just went with the variable because back then their fixed rate was 8%, which I thought was terrible. It was I think it was a wash rate of 8%. I think they credit you, I think they charge you 8% and they credit you, no, they credited you less. I can't even remember. I remember the rate of 8%. So when I bought my Mass Mutual policy, I went with the 5% variable rate. And then when I got my Guardian policy, that was part of the reason I went with a much higher amount in Guardian. There's a bunch of other reasons as well, but I went with a higher amount in Guardian knowing that I have that wash rate. So if for some reason the interest rate environment changes, those variable rates that those those non-direct recognition companies offer, those variable rates can go up, and they can go up higher than the dividend rates, in which case not going to be that great of a deal to be in a non-direct recognition company at that point if you have a lot of loans out that are subject to that higher rate. I'm going to have that mix, so I'll be able to move my funds to whichever one makes more sense. So right now, that means I borrow as much from the Mass Mutual policy as I can because it's 5%, and I put those towards my other policies. So I have my equity sitting in my Guardian policy that I have 5.62% dividend rate. Now, if I pull out the Guardian, I get a 6% wash rate, but I'm paying 6%. So in that case, I don't get any spread. I don't get any arbitrage. But when I go 5% from Guardian and get a 5.62% from, 5% from Mass Mutual, and I get a 5.62% from Guardian, now I got a little bit of a spread there I can work with. Plus I get the 6.2% from Mass Mutual. So wins all around when I do that. So yeah, I don't think one is necessarily better than the other. It's going to be situational. I prefer to just have a mix of them so that I can choose. Not everybody's going to be in that position, so you're going to have to choose what's best for you. Would you like to have a lower starting out variable rate, which is what all of the non-direct recognition companies offer right now? Pretty good loan rates because our interest rate environment is very low, and you have that chance for arbitrage. I think that's a good path for people who are looking to make their money inside their policy. Now, that's also why I like the IULs. When we look at IULs, we're looking to make our money inside the policy. You're not going to make a whole lot of money inside the policy, though, because those rates just aren't that high. In the IUL, we can. The rates have the potential to be a lot higher. But in the whole life policy, the rates aren't that much. I mean, yeah, you'll get decent growth in it, and it's good. You don't want to turn away from any growth. You would like to get as much as you can possible. But for the most part, those whole life policies, we are planning to use them to get the growth outside the policy. The reason we're accessing those funds is because we're planning on getting growth outside the policy. So I don't put a whole lot of stock into quite so much as to whether it's direct recognition or non-direct recognition, as long as I can get a little bit of a spread. That's all I'm shooting for. If I can get a little bit of a spread, I'm pretty happy, and I'm really worried, and I'm going to put most of my effort into what I'm doing outside the policy, not so much in the policy once we get it started and going. Because once we get them started and going, they're all going to perform pretty good. They're all going to perform certainly well enough. We'll be happy with that. So hopefully that answers your question.
This was a question asked and answered during one of our WealthCare Wednesdays live streams. If you have any questions, leave them in the comments section below, or join us on one of our WealthCare Wednesday live streams where you can ask the question and we'll answer it on the air live. Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.